Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update, and this is going to be a big one. I'm going through a lot of data, and we're going to talk about changes in the market. We're going to talk about some of the stagflation indicators that are out there. So buckle up your seatbelt, grab a glass of wine. We're going to go through a lot of stuff today. If you remember from previous videos, my call for a recession was June of 2024. I have not changed that call for more than 11 months now, and it looks like we're finally starting to see some of the data come in showing stagflation. So what is the average time frame from when the Fed stops raising interest rates to when a recession starts? It's usually 11 months. So that puts us at June of 2024 is when this recession is going to get underway. We're actually seeing a contraction in the economy. The ISM index came in at 49.2. Anything below 50 is a contraction. It was expected to come in positive above 50, and it came in below. We also have a lot of data that is showing us that the recession is coming sooner rather than later. Now, this does not mean that there's going to be potentially a big stock market crash. It could come, but the stock market could actually perform a lot better in an inflationary environment than most people realize. Consumer confidence has been coming in very weak. We are seeing very soft payroll data. And it's not just the data that's coming in bad, it's the difference between full-time jobs and part-time jobs. Over the last 3 years, we've lost about 3 million full-time jobs, and we've added about 4 million part-time jobs. This has a significant impact on consumers' purchasing power when you're seeing a lot of jobs being replaced that are not as high paid as the ones that are being lost. A lot of companies have been reporting earnings, and their guidance has been really interesting. Companies that you would think would do well, even in a recessionary type environment, are reporting that their sales are down and their guidance is down. Companies like McDonald's, companies like Starbucks, companies like Hershey's Chocolates and Coca-Cola, even Estee Lauder reported very poor guidance in future earnings. Even companies like Costco, they missed on their sales revenue that was expected by analysts. At the same time that we're seeing a lot of these companies report bad economic results, we are seeing inflation data come in a lot hotter. If you look at the ISM Businesses Paid Index, the prices paid, that's a lot higher than analysts expected. We're going to get the PPI and the CPI this week, and I expect those to come in hotter than expected. And when you're seeing inflation data come in hotter, at the same time we're seeing economic contraction, this is the very definition of stagflation. One of the ways that the Federal Reserve and the government has been combating this inflation is with higher interest rates. And of course, we're all paying those higher interest rates. We see that. We're seeing that in credit cards. We're seeing that in auto loans. We're seeing that in 30-year fixed mortgages above 7% now. The problem is if you go back and look at when the government raised interest rates in the early 1980s to combat all the crazy inflation from the late 70s, we were in a much different financial situation. The government was running 30% debt to GDP. Today it's 130% debt to GDP. So when you raise interest rates in this environment, someone's collecting all that extra interest. And because all those people out there are collecting higher interest, they're getting that money and they're able to use that. That's inflationary. For example, if someone has $500,000 in bank accounts that were earning 1%, they were getting $5,000 a year in interest, and now they're earning 5% on the same $500,000. Now they're getting $25,000 a year in interest. This is money that they can use, that they can spend. So in this environment, when you have so much debt, higher interest rates actually can lead to more inflation, not less inflation. So the higher interest rates actually contract the economy, cause auto delinquencies to go up, which are at all-time highs. We're seeing credit card delinquencies. So the higher interest rates cause economic contraction. At the same time, they're also inflationary. One of the biggest data points we actually got last week on Friday is a huge concern, and that's the consumer sentiment data. That data came in at 67.4, which was a huge miss. It was probably the biggest miss ever in the history of the data. If you looked at consensus estimates, it showed that they expected a reading of 77. In fact, the range was between 74 and 79.5, and it came in at 67.4. So consumers are not happy, and the two areas that they cited are the biggest problems in their life is, number one, is inflation. Prices are going up. People are worried about what they're paying for food and gasoline and everything else in the economy. And so inflation is a big concern. The second biggest concern in this consumer sentiment was the higher interest rates. People are paying higher interest on their credit cards, their auto loans, their mortgages. The problem is if you raise interest rates to combat the inflation, you're going to make the interest rate problem worse. And if you lower interest rates to solve that problem, you're going to make the inflation problem worse. So the Fed has boxed itself into a corner, and this is what we're seeing. We're seeing that they cannot do anything. If they raise interest rates further to protect the economy and consumers from inflation, we're in trouble. And if they end up keeping the rates lower to solve that problem, they're going to cause inflation to go higher. Now, how is the government going to deal with this major problem of inflation and higher interest rates? Well, there's actually a recent interview that was given by a reporter asking Jared Bernstein, who's the chief economic advisor to the President of the United States, about the economy and MMT and inflation. And one of the questions that was asked was, why does the government even need to borrow money at all when it has a printing press? And the answer that he gave is absolutely shocking. I cannot believe that this guy is in the position he is as the chief economic advisor to the President of the United States. You have to see this interview clip.
Like you said, they print the dollar. So why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah, so a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to, I guess I can't really talk. I don't get it. I don't know what they're talking about. Because it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise, we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing.
Now, he clearly couldn't answer the question. And the real answer to that question is so simple. Even a basic freshman economics student could answer this question. And it's real simple. Why does the government need to borrow money when it has a printing press? Because if the government doesn't borrow the money, it's going to be extremely inflationary. See, if someone loans the government some money, they don't get to spend that money. They've given it to the government to spend, and the government has to pay them back with interest. And so that's a net wash. Essentially, someone doesn't get to spend that money. They're giving it to the government. They're going to get the money back in the future with interest, okay? But in the event that the government just prints the money, well, now you have someone that has money that they can go out and spend. They're not giving it to the government now. They'll maybe invest it in a different way in the economy that's inflationary. And at the same time, the government just prints money and spends it. This is what countries like Zimbabwe and Venezuela do. This is when you have a currency crisis. So the fact that someone's even asking this question is ridiculous. And the fact that this guy answered it in the way it did, I mean, this guy should be fired immediately. Now, how does the government fix this problem of high inflation and high interest rates and going into a recession? Well, we can actually go back through history and look at how they've solved it in the past. Now, it's different today, but in the past we were on a gold standard, which means that the US dollar was backed by actual physical gold. Well, in 1933, Franklin Roosevelt decided to take us off the gold standard by changing the value of the dollar to gold. Now, what ended up happening is we ended up going back on a gold standard at a different valuation. So in 1933, he forced all Americans to turn in all their gold, and in exchange, they got $20 for every 1 ounce of gold that they turned in. Well, what happened is they then revalued that gold in the future at $35 for 1 ounce of gold. This is a 75% increase in the price of gold. And so this was a way that the government was able to confiscate everyone's money in order to pay for all of the major problems and debts and recession and higher interest rates that were affecting the United States during the Great Depression. Now, during World War II and during the 1940s and 50s, we had a big problem with inflation, and the government solved that by actually spending a lot of money, and they actually spent that money in ways that may be positive for the economy. They used all this money to build infrastructure, to build roads, to create new power generation projects, to build dams, and all the things that helped propel the country into a better situation. But back then we had a trade surplus. We made all the stuff. After World War II, the rest of the world was bombed out, all the manufacturing plants were gone, and we had all of those manufacturing plants. So we had a major trade surplus. Today we're in a much different situation. We have a major trade deficit. It's not just government debt that I'm worried about. I'm also worried about corporate debt. There's what's called the corporate debt wall. $1 trillion resetting this year, $1 trillion next year, and $1 trillion the year after that. These are corporations that actually have a bunch of debt that they're paying a lower interest rate on than today's current interest rates. So when that debt comes due and they have to refinance that debt, they're now going to have to pay a higher rate of interest on that same debt. That is a major problem. Part of the commercial corporate debt that we're worried about is commercial real estate. A lot of these loans that were taken out on buildings, office buildings, apartment buildings, various commercial projects, a lot of these interest rates are variable. And so when the loan was taken out, it was taken out for 5 years or 7 years or 10 years fixed, and then it changes to a variable rate. When that happens, a lot of these projects and properties are going to be in trouble because they have a certain amount of revenue coming in from the rents, and they have a certain amount that has to be paid to the bank on the mortgage. And if the mortgage balance remains the same, but the interest rate goes way up, those payments are going to go way up, and this is going to create a lot of problems. And some of these properties have so much debt on them that they're going to go into default, and this is going to create a banking problem because these loans are going to be going back to the banks. And we're already seeing this in the commercial real estate sector, crazy cases all over the country of these properties being sold at just rock bottom prices. In fact, in some cases, there's been cases of pension funds that are actually giving up properties for $1 just to please take over the debt that we owe on this property because it's essentially underwater at this point. These are properties that people put big down payments on that essentially all of that equity has evaporated in the current higher interest rate environment. Now, how are they going to fix the problem today? Well, today it's a little different. We're not on a gold standard. And so if you look at inflation and how it works, if you go back for the last 50 years, what has the average inflation rate been in the United States? If you include all the up years, the down years, well, the average has actually been 4%. Now, officially, the inflation rate this January was 3.2%. Last January before that was 8.7%, and the January before that was 5.9%. But the official average is 4% a year. Well, 4% alone is a big number. In fact, if you take the average life expectancy of a human being, which is about 80 years, and you say at the time someone is born, if whatever they can buy for $1 the day they're born, 80 years later, on the day they were to pass away, how much money would you have to buy the same number of goods and services? It's actually $23, 23 times, and that's just at 4%. Now, I think the percentages are going to go up a lot more over the next, say, 10 to 20 years or longer because of the current debt problems. And one way the government does it is to actually just print up the money. Now, how do they do that? Well, they actually have the Federal Reserve buy up the debt. So instead of having the private sector buy government debt, which is not inflationary, they just have the government buy up the debt. This is the Federal Reserve. Well, the government owned $700 billion in debt in 2008. Today, it's $7 trillion. It's a ridiculously larger number today than it was just in 2008. So this is all the money that's been created out of thin air. A lot of it is quantitative easing during COVID and trying to bail out the economy after the 2008 housing bubble crash. But the government can continue to do this. They can just issue bonds and then buy their own bonds. And today, if you look at that $33 trillion the government owes in debt, they really don't owe $33 trillion. If $7 trillion of that is owned by the Federal Reserve, they actually only owe $26 trillion, not $33 trillion, because $7 trillion is owed to the government. They owe the money to themselves. And the government, I believe, will do this. It's called yield curve control. They will continue to issue new bonds, and they will buy their own bonds, and they will force the interest rates down. This is extremely inflationary. Now, one way that the government could solve all this problem is to collect a lot more in taxes. Now, how they might do this is actually pretty obvious if you look at past history and how they might accomplish this. And that's simply by raising capital gains tax rates in the face of creating all this inflation. And this is interesting because Biden just proposed this, raising the capital gains tax rate from the current 20% up to 44%. See, if the government raises capital gains tax rates up, and they create a lot of inflation that makes asset prices go up, you essentially can steal the net worth of as many people as possible to pay back all of these debts. And these capital gains rates, when you talk about 44%, it's not really 44%. Everyone talks about Europe and how high the tax rates are in France and Sweden and these other places. But here in the United States, we have something called state tax. And unless you're in Florida or Texas or one of these states that does not have any income tax, you're paying an additional tax on top of the federal tax. So here in California, if we had to pay 44% in capital gains tax plus 13% in state tax, you're talking about 57%. So if you buy anything, a house, a stock, anything of value, a baseball card, a comic book, if it goes up in value, the government would then be able to take more than half of all of the appreciation in the value of that asset as it goes up. This is one way the government could confiscate a lot of money in today's environment. Since we're not on a gold standard, this would be a really smart way to do it. Now, one of the other things that Biden proposed is a capital gains tax rate on unrealized capital gains. This I'm not worried about. I know the internet was all going crazy and there was all this buzz around how this would work, but this is unconstitutional. I do not think this would ever pass. This is taxing assets that have not been sold. So for example, if you bought a stock or you bought, say, a rental property, and that rental property went up in value, say your $500,000 rental went up to $700,000. Okay, well, what his proposal was is that you'd have to pay a 25% tax on the increase. So if your rental property went from $500,000 to $700,000, even if you didn't sell the rental property, you'd have to pay $50,000 this year in extra taxes. Well, I don't think that that is constitutional. It doesn't make any sense taxing unrealized gains, because what if the property values went back down, right? If it went from $500,000 to $700,000, you paid a $50,000 tax, and then all of a sudden the price of houses dropped back to $500,000, then what, right? Then it would be applied, future potential capital gains. I think this creates an absolute mess. So I'm not worried about this. I do not believe they're going to tax unrealized capital gains, but they're going to tax actual capital gains. And this is interesting because if they do raise the capital gains tax rate, they'll probably tell people ahead of time what the increase is going to be, and they'll give people some time to actually sell a bunch of positions. Well, this is going to create a lot of money for the government, because if everyone's going to pay 20% and it's going to go to 44%, well, they're probably going to look at any asset that they have a capital gain on and sell it right now in order to pay the 20% rate instead of waiting until after the law changes and having to pay 44%. But the combination of a higher capital gains rate and a situation where inflation is going wild, you have the situation where the government can actually force the prices of assets up using inflation. At the same time, they use capital gains taxes to steal those gains from the American people. Another area that is a big inflation concern going forward is all of the baby boomers that are going to be collecting Social Security checks. These are people that are not contributing to producing products or services for the economy, but they're people that are collecting income that is able to be spent into the economy. This is clearly inflationary if the government is not collecting enough money from current workers to pay all of the Social Security payments to the retirees. And they're working on changes to this program. Now, obviously, what retirees are spending their money on will have the biggest increase in inflation, in prices. And so these are things like going out to restaurants, going on vacations, going on cruises, things that retirees do. These are areas that will have a bigger price increase and a bigger inflation impact. But one of the proposals that they're working on, and this is kind of behind the scenes proposals, if you dive into some of the things that Congress is doing, this isn't something that's going to hit the mainstream media before the election because they don't want to influence the election. But they're talking about revamping the Social Security system by actually lowering the age to age 58. And you might think, well, gee, that's going to make the problem worse. And actually, that's not true. It's going to make the problem a lot better. And the reason is because Social Security, you used to have to be 65 to get your Social Security. And one of the ways the government solved paying out as much money is they lowered the age to 62 that people could take it at a reduced amount. Well, because the average American doesn't understand how inflation works or cost of living adjustment works or the compounding effect of these COLA adjustments, people that are taking it early on average end up costing themselves a crazy amount of money, over $100,000 over the average lifetime. And so by taking it early at a reduced amount, you're not picking up all the cost of living adjustments. So the proposal is that they reduce it to age 58 and reduce it even further. So someone could take their Social Security as early as 58 instead of age 62. And now they're in a position where they get a much smaller check, which is even a bigger impact. So this will save the government quite a bit of money if they make these changes where they lower the age from 62 to 58. Now, if you're an existing client, you know this is an area that we focus on, which is maximizing Social Security. So obviously in this environment, you got to take your Social Security the right way. And of course, we have a computer algorithm that we can plug your information into, and it's going to print us out a report that tells us exactly mathematically how you should file for Social Security to get the most out of the program. And so that's a clear, obvious response that we need to have to this problem. But the other thing we need to think about is taxes, right? If they're going to raise tax rates, if they're going to collect a bunch of money, and they're going to create a bunch of inflation, well, how do we take advantage of the increase in asset prices without paying the tax? And the clear winner here is a Roth IRA. A Roth IRA is simply the best place that you can put your money. And under current rules, you can only add a little bit each year based on Roth contributions, either on your own individually or within an employer 401k plan. So obviously you want to take advantage of that. However, one other area that you should seriously consider is how can you convert as much money from your current IRAs, TSPs, 403Bs, all of your current 401ks, how do we convert that money over to a Roth IRA? And we are experts at that. Obviously, if you're working with us, you already know this. We put plans together on how to get as much money into a Roth IRA as possible. And this is going to be so valuable for people in the future, because if the inflation takes off and you see a lot of those asset prices going up, and a lot of people are paying capital gains tax on those increases, and you own those same assets in a Roth IRA, well, you get to collect all of those gains tax free. Now, you may have heard in previous videos, and something that I would repeat over and over again now, is that you need to invest in value stocks versus growth stocks. Growth stocks have had a good run, but the valuations are absolutely out of sight. And if you look at history and you look at interest rates, it's very interesting. In periods of time where you have interest rates that are low, say under 3%, growth stocks typically outperform value stocks by quite a bit. And you can go back and look at history and when this has happened and see that growth stocks outperform value. And obviously we've seen that for the last few years while interest rates were low. But if you look at history and you see, well, when interest rates are high, say they're above 4 or 5%, what happens? Well, value stocks outperform growth stocks handily. And there's been a lot more time that the interest rates were higher and a lot more time that the value stocks outperformed growth stocks. And we're going into one of those periods where not only do I think value stocks will outperform, the current valuations on the value stocks are substantially lower than the current growth stocks. So you have to look at companies based on actual earnings, actual value. I'll give you an example. Apple is a value company that is masquerading as a growth company. See, Apple doesn't have a whole lot of growth potential in the future, but they're trading this huge PE multiple like they're going to grow in the future. Well, that's a company you certainly would not want to invest in. It's really a value company that is extremely expensive. Company like Costco is another example. That's a value company, but it's trading at really, really high valuations. It's ridiculous what the current PE ratio is on Costco. It does not, their current profit and their future profits do not justify the current price. But if you look, there's a lot of companies that are out there that are actually undervalued, and a lot of these are in areas that do well in a recessionary environment. Energy, for example, agriculture, metals, gold, copper. When you think about copper, it's really interesting. It takes 6 times as much copper to produce a Tesla vehicle than a normal gas-powered vehicle. We're going to need a lot more copper. Copper is used for electricity and infrastructure. When you do a Gemini search, it takes 17 times more energy than a Google search. We're going to need a lot more energy, right? Oil prices. And what happens during an inflationary environment? Well, in the 1970s, oil was one of the best investments you could possibly be in during that inflationary environment. So you have a combination of undervaluation and a huge potential demand going forward. So we know that value stocks are the way to go. And we have great options for our clients in that. Obviously, the Copley Tactical Fund, we're focused on that. It's been performing extremely well, in addition to the other value options that we have. Now, what if this recession gets worse? What if it ends up being a lot worse than we expected? Obviously, watching that interview, that video clip of the Chief Economic Advisor to the President, it gives you pause and say, well, wait a minute, do these people really know what they're doing? Well, what if the recession gets worse? What if they can't maintain it? What if they're trying their best to keep the economy and the stock market up for the November election and they just can't do it? Well, I seriously think that what we need to focus on is inflation, because in the event that we have a big drop in the stock market or a big drop in economic numbers, yes, the accounts will go down temporarily, but I think they're going to be right back up in a very short period of time with inflation, because the government response to a big drop in economic numbers in the stock market is going to be to come up with all kinds of money printing and inflationary things. In fact, Freddie Mac just announced a proposal. I mean, it's absolutely insane, doing second loans. These are home equity lines of credit behind people's houses backed by the government. I mean, can you imagine being able to take money out on a second mortgage backed by the government? Right now, second mortgages are very expensive. If you go to a bank and want to get a home equity line of credit, the bank's going to charge you a much higher interest rate, and that's because of the risk involved. If home prices come down, this is a problem. Those banks can get into trouble. But if the bank can originate that home equity line of credit and just pass all the risk on to the government, well, of course, people are going to do that. Well, this is extremely inflationary. If this proposal goes through where they're talking about 3% interest, home equity lines of credit, where Freddie Mac and the government is backing all of these second mortgages, well, you should take out a bunch of second mortgages on your house and go out and buy gold because this is extremely inflationary. I cannot believe this proposal would go through. It makes no sense. It's as if we didn't learn anything from 2008, that the solution to all this debt and higher interest rates is not more debt. It's not more government-backed guarantees. This is what got us into trouble in the first place. Now, during an inflationary environment, one of the worst things you can have your money in is a traditional 60-40 portfolio, because the S&P 500 went nowhere during the 70s and the bond market actually dropped. You lost money. So you certainly would not want to be in one of those portfolios in this inflationary environment, which is what is commonly proposed by people at Fidelity and Vanguard and all these other companies that are out there proposing modern market theory and 60-40 portfolios. But the buffered index, which we're doing, has been performing extremely well, and I think this is one of the best places to be in this environment. So how it works is the current portfolios we have two options. Now, the 5-year barrier where you got the leverage return is not available right now. The pricing was not good, so we're hoping to bring that back in June. But we have two great buffered indexes available right now. One is an 18-month and one is a 2-year. On the 18-month, it's very simple. If the S&P 500 goes up over the next 18 months, you can earn up to 14.6%. So if the market's up 5%, you get 5. If it's up 10, you get 10. If it's up 14, you get 14. Now, if it's up 20 or 30%, you just get 14.6. In exchange for giving up everything above 14.6, you're able to buy an insurance policy that guarantees you cannot lose money. Yes, very simple. You cannot lose money. So if the stock market is down at all, if it's down 5%, 10%, 20%, 30%, 40%, doesn't matter, you get 100% of your principal back. And so this one is a good option for someone who's very conservative, who wants to earn up to 14.6% over the next 18 months and have no downside risk. Now, the second option is a 2-year. This one is a little bit higher performance, carries a little bit of risk, but not too much. It's pretty good. This one has a 24% cap. So over the next 2 years, if the stock market goes up anywhere from 0 to 24, you get the whole thing. If it's up 10, you get 10. If it's up 20, you get 20. If it's up 24, you get 24. But if the stock market is up 30 or 40%, you're just going to agree to take 24%. That's the maximum return that you're going to get. Well, in exchange for giving up everything above 24%, you're able to buy an insurance buffer of 20%, and it's a dual directional, which means if the market goes down, you actually get paid on the way down. So if the market's down 5%, not only do you not lose, you make 5%. If the market's down 10, not only do you not lose, you make 10%, all the way down to 20%. Now, if the market was down more than 20%, you have a maximum 20% reimbursement. So if the market was down, say, 25%, you'd get reimbursed 20, you'd still be down 5%. So there is some risk on that one. Obviously, the 18-month has no risk, but you have a much higher return potential on the 24-month with the 20%. Plus, it's dual directional. So if the market was down 10%, you would just get your money back on the 18-month. On the 24-month, you'd actually make 10% on that investment. So both are great options in this environment. We also have guaranteed interest, still pretty good. It has come down a little bit, but we're getting still really good rates. And so take advantage of it while they're still here. We have the current MIGA rate. The 3-year is at 5.32%, guaranteed 5.32% interest every year for the next 3 years with some liquidity feature, which is nice. And on the 5-year, it's actually 5.22%. Now, we have an inverted yield curve. You actually get a higher interest on a 3-year than a 5-year. Well, the reason for this is the market believes that interest rates are going to come down, which could happen with the government doing what's called yield curve control, where they keep interest rates down by printing money out of thin air, buying their own debt, driving those rates down and letting inflation continue to go wild. So the 5-year at 5.22% might actually be a better idea than a 3-year at 5.32% because it locks in that higher rate for a longer period of time. Now, obviously the Copley Tactical Fund is doing great, and we want to invest a lot of money in that because we are focused on investments that do well in inflationary environments. We have a large position in gold, we have a large position in agriculture, in real estate, in energy, lots of oil investments in there. And we also have a nice exposure outside the United States. In fact, over 20% of that portfolio is international, and we're focused very heavily on emerging markets like India, countries like Brazil, countries that produce a lot of commodities, and they're kind of neutral when it comes to this whole United States versus China, Russia geopolitical rivalry that we're having going on in the world. So being invested in those countries that produce a lot of commodities, have younger populations, is a good idea in this environment. So all of those are great options. We definitely want to help you. In the event that you have any questions about your current accounts, feel free to reach out. Obviously, if you already have your investments with us, we're taking a look at all of these things and making those adjustments. If you're not a current client of ours, give us a call. We have financial advisors waiting to talk to you about your investments and getting you in the right position. And now that we're seeing all this stagflation data, now's the time to make some adjustments because things are changing within the environment, in the economic environment, and you need to adjust your investments to make sure that you're in the best position going forward. Thank you all for watching. Hope to see you in our Mission Valley office very soon.